Welcome back, ladies and gentlemen. It's now time to navigate a very opportune theme. And let me begin by saying that we see India as one of the fastest growing economies in the world. And with average age less than 30 years, equity investing is done by most with the expectation of abundant wealth creation. And to put this in a number, it is an aspiration of making 10 times returns in 10 years. Of course, many stocks have shown such returns, but only a very few portfolios could achieve such multi-bagger performance. And this is because market goes through multiple cycles, phases with rotating sectors. Ladies and gentlemen, our next panel is comprised of those few experts who have demonstrated the identification of multiple businesses in the portfolio with potential of much more than 10x returns over 10 years. And that's why the topic of this discussion really is driving portfolios across multiple cycles for achieving 10x returns in 10 years. Let me introduce the eminent panelists to you on this panel. The first panelist, ladies and gentlemen, is Mr. Manish Sonthalia, who serves as the CIO and Executive Director of Motilal Oswal AMC. He comes armed with over 30 years of experience across equity fund management and research covering Indian markets with over 17 years with Motilal Oswal. Mr. Sonthalia holds a bachelor degree in commerce honors from St. Xavier's College, Kolkata, and is the member of the Institute of Cost and Works Account of India, the Institute of Chartered Accountants of India, and the Institute of Company Secretaries of India. He has completed his Masters of Business Administration and Finance from IIS WBM. He has authored a paper, A Rising Consumer Class on Indian Markets, published by Global World Economic Forum in the year 2010, and he has contributed to various articles on finance and capital markets in various e-papers and magazines. We extend a very warm welcome to Mr. Manish Sonthalia. We also have with us Mr. Samit, who is the founding partner and CIO at Sage One Investment Managers. Mr. Vartak is a CFA charter holder, has worked closely with various companies in the US and India, advising them on business strategy, profit optimization, growth, and valuation. He returned to India in 2006 after spending a decade in the US, working initially in corporate strategy with Gap Incorporated and PwC Consulting, and then with Deloitte and Ernst & Young, advising companies on business valuations and M&A. I extend a very hearty welcome to Mr. Samit Vartak. And ladies and gentlemen, this session will also be moderated by Mr. Kamal Manocha, who is the founder and chief executive officer at PMS AIF World. He is responsible for driving the overall business across both wealth and content management. Over the past 3 years, PMS AIF World has conceptualized various innovations under Mr. Kamal Manocha's capable thought leadership, the most recent one being the Quality, Risk and Consistency Framework, created to deep dive the space of portfolio management services. Mr. Kamal Manocha brings with him 18 years of experience, holds a master's degree in management and a bachelor's degree in economics from Hansraj College, Delhi University. Sir, we request you to moderate this very, very interesting session. Please take it away.
Thank you so much, Aishwarya, for this beginning. So the last panel, that I moderated was pertaining to long-short funds. That had realistic fund managers who were trying to project around 12% kind of returns. But we have to straight away jump to this optimistic, panel where we are trying to understand how to build a portfolio for 10x kind of returns over next 10 years and kind of how to manage that across market cycles, which basically conveys a number of around 26-27% as a CAGR. So my first question, to you, Manish, that over last 1 decade or maybe more than 1 decade, every one of us have most of us have learned equity as an asset class through Motilal Oswal. Motilal Oswal's, QGLP is one of the philosophies, which is the only philosophy which is actually known by advisors, known by even investors. I don't know any other popular fund where one, not only knows the fund, the product, the fund manager, but also its philosophy. So obviously, there is some definite, good work which has been done. And then the wealth creation studies that Motilal has done over years. So, but the thing is, over last 5 years, the performance of Motilal Oswal funds has been relatively average. Maybe because you were focused too much on quality and growth. You were not focused too much on quality and growth, and you were focused on maybe value and price also. And at present, kind of we are seeing over last 5 years, quality and growth has kind of got too much returns. So the context of my question is that I want to first understand from you, before we begin, that what are your beliefs over next decade? Is 10x return going to be possible, in the context of your philosophy? What are your views in this regards? I first want to understand, from investors' perspective. Investors really want to understand this thing. That do you really believe that over next 10 years, is it possible to make 10x kind of returns?
Yeah, so basically, what we have understood over the last, since 2003 that we have been managing public money and advising clients even before that, is that in India, only long-term approach to investing works. You may try any other style of investing, long, short, or, hedging and all of that. But the crux is that two-thirds of companies in India don't even earn cost of capital, and only one-third of businesses in India earn cost of capital or exceed cost of capital. And in that context, shareholder returns get created only when your ROCs of business are much more than cost of capital, and they sustain this trajectory of growth over long periods of time. Basically, the idea is to understand how much money a company is going to make over the journey till at about the point in time it goes through a saturation or a decline phase. That's the ultimate truth in terms of analyzing and how much money you're going to make from stock. Because stock prices are nothing but net present value of future cash flows of a business. So in India, what we have understood, tried out everything, buy and hold approach type of investing works. And since two-thirds of businesses in India don't even earn cost of capital, quality, growth, longevity of growth, and price all are important in that context. Now, coming to whether 10x returns is possible in 10 years is very much possible. Only difference this time around is what I believe is that a lot of value these days are getting captured when companies still remain in the unlisted space. You have companies which are very young when they approach investors for seed capital and then go through first round, second round, third round. And by the time they come out with IPOs, a lot of value is already captured. That's not to say that growth is not possible even beyond when they come into the listed markets. It is possible. It has happened. It will happen. In the context of growth of India, a 6 to 7% real GDP growth translating into 11 to 12% nominal growth, all of this is very doable. But I think both within the listed space as well as in the unlisted space, the best approach to having the 10x returns in next 10 years, that is a 25% CAGR sort of a return, is to have a mix of both your unlisted and listed. The philosophy has stood the test of time. You should not buy companies which earn less than cost of capital. There is no case for shareholder value creation. Quality of management is extremely important. Endeavor to buy companies which can actually compound profits at 25%. That is the ultimate truth. If the company's earnings growth does work at 25% CAGR, you are going to make more or less those sort of returns over the longest time frame that you want to invest. That is to say, if you want to hold stocks for next 5 to 10 years, that sort of returns is possible, provided that you don't buy it at very elevated valuation. Assuming that an investor really doesn't have any handle on the valuation part, it is a function of the market. What is in the manager's hand is basically the buying price and the selling price. So what is under control is to estimate whether those sort of growth rates in profits in companies will happen or not happen. And in India, having the experience of the last 25, 30 years, only growth investing works. Value style of investing, the traditional definition of terms, low price to earning, low price to book, really doesn't really work. They may be tactical plays for short-term periods, but that's about it. Because if companies don't earn cost of capital, they have no case for really achieving very meaningful increase in market capitalization. So that is what we believe. Documented philosophy and process. We are fine-tuning it every year, and in these last 5-6 years, what we have seen is that valuation re-rating has happened massively. Without earnings growth on the back of very low cost of capital and very benign liquidity situation. Of course, these are not normalized times. In normalized times, the wheat and the chaff will be separated and growth investing will only work. And you have to figure out, the rates of growth in companies that you want to invest in.
Right. I really like, the candid and the intuitive answer to, this question. Moving on to Samit, what are your beliefs? You have actually kind of multiplied wealth more than 10 times over last 10 years for your clients. But now over next 10 years from these levels, do you still hold the same promise? Do you still hold the same belief?
So, as Manish was saying, it's not that easy for a 10x in 10 years kind of returns. So, I mean, consider the, basic math, right? India's long-term earnings growth, for the Indian corporates have been maybe around 13, 14%, right? Which is closer to the nominal GDP of India, right? And I think that is reasonably possible. Fund managers delivering that kind of returns is possible because markets will deliver in the long run those kind of returns. Now, adding a 5% alpha itself, it's a Herculean task. It's not that easy because adding a 5% alpha net of fees, meaning you probably need to add 7% alpha. And so if you are assuming 13, 14%, that means to generate 18% return, probably you need to deliver 20, 21% kind of return, right? And that itself is extremely difficult, right? And I think, see, as a fund manager, there are too many drags because if you manage large AUM, there is no option but to invest in the large caps. I can tell you it is extremely difficult, probably 1% probability that you will be able to, if you invest in the top 100 stocks, top 150 stocks, almost impossible to deliver 10x in 10 years kind of returns. The only space where you can generate 10x in 10-year returns is in small caps and maybe the smaller mid caps. And there, the biggest drag is the AUM that you manage, right? So if a fund manager keeps, sort of a limit to how much you want to manage, I think that's the only way you can do it. For an individual investor, who has the flexibility of getting in and getting out, that is much easier, because I myself, we manage, 3,000 crores, out of which the small cap itself is only 700 crores. And 700 crores investing in 20 stocks, meaning that we invest 35 crores in one stock. There are very few companies which are good quality, high growth companies where we can find such liquidity to get in and get out, right? The in and out impact cost for me typically is, in a 4 to 5 year period can be about 20 to 30%, right? So in a 5 year period, just because of the size that I manage, it takes away probably 4% or 5% annualized return, right? So you got to make up for that. For me, it was much easier doing that in 2009, 10, 11, 12, when I was barely managing any money, managing my own capital. But it becomes more and more difficult, right? So even for an investor, one has to look at, those aspects. And yes, we have done that in the last 10 years. We have done more, it's been 13x or 14x in the last 10 years, which is, close to 30% kind of a return. Going forward, see, again, even if you look at last 10 years, there is a lot of luck factor, which is important, right? And if you look at even last 5 years, from 2016 to 2020, almost, 4 years, the returns were zero. Because from 16 you went up in 17 and 18, but then you gave up in the mid and small cap space. You spent 4 hours returning zero, and then within the next 1.5 years you tripled from the bottom of the so the returns are extremely concentrated. So a lot of times what happens is that if you start at the wrong time at the peak, it's an extremely difficult target to achieve 10x in 10 years. So your starting point will also make a lot of difference. So for me, what I've seen, is that if you have a portfolio, say, of 10 stocks, there will be a couple of stocks which will deliver you that extremely superior returns. And I have never come across any multi-bagger in my portfolio where the starting valuation was high. So I've never entered into a stock which was a 40 or 45, 50 times multiple, and it has become a multi-bagger. For me, whether it's a Bajaj Finance, the starting price to book was 1.5 times. PI Industries starting multiple was 12, 15 times. Amar Raja Batteries, again, low teens, kind of a multiple. Lao Pala, single digit multiple. So for a 10x in 10 years, what I've seen is that your couple of stocks will be huge winners, and I've never held a stock for 10 years. Most of the returns will happen in the first 4 or 5 years, and whether it's a Bajaj Finance, you'll see that the valuation gets re-rated by maybe 2 or 3x or 4x, sometimes 5x. Like Laopala went from 9-10 times multiple to 50 times multiple. Bajaj Finance went from 1.5 times multiple to 10x, 9x multiple at the peak. Right. So you will, in a 5-year period, you should expect that maybe 2 or 3 times multiple re-rating, as well as maybe 2 to 3x earnings growth. So that itself gives you about 9x multiple in couple of stocks. The remainder of say 80% of the stocks, even if they deliver you average market returns, which are say 15%, 16%, you are set for a 10x kind of a return. Question is, are you able to find those 2 or 3 stocks in your portfolio where the starting multiple is so low that in a 4 or 5 year period, whether that multiple can be, re-rated 2 or 3 times. Otherwise, without multiple re-rating, it is extremely difficult to get a 10x in 10 times return at a portfolio level. There will be some companies where the earnings growth is so high that even if you enter at 20, 25 times P multiple, you can generate 10x in 10-year kind of a return. Most investors will not hold any stock for 10 years. It is extremely difficult. Even if you hold it for 10 years, like for example, I have held RT Industries for long period of time. But if you see, majority of the returns were in that 3-4 year period. The remainder period has been less than average kind of returns, right? So it is extremely important that if you look for 10x in 10 years, it will be very difficult to do it in a buy and hold kind of a strategy. Most companies will not be able to grow at that 25-26% earnings growth rate. And most companies will get re-rated within the first 2-3 years as soon as they start delivering. Right. So I think the starting valuation, as well as working in the small cap, mid cap space, that's the highest probability of you generating 10x in 10 year returns.
Well said. In fact, I would say that the foremost point to actually achieve 10x return in 10 years at a portfolio level is to select a portfolio manager which you want to hold on for 10 years, because that is the foremost requirement. And investors may not hold a stock for 10 years, but they kind of ought to select a fund manager that they want to hold for 10 years. And that is the reason, we are trying to, do all these realistic questions from the perspective of investors. My next question to you, Manish, Motilal is a research company, and in the context of various sectors, various type of businesses, you have a very, very deep team which kind of throws a lot of data. Analytically speaking, over next 10 years, will the same style, will the same approach of buy right, sit tight, which is buy and hold, generate, the best optimum, best possible returns? Or you think that now going forward in this decade, the sector rotation as a strategy will be kind of more required, and hence the churn in the portfolio will be more going forward to actually achieve the highest possible returns?
So really, we really don't want to have a strategy where the churn rates are very high, because you don't live your conviction, the conviction that you bought through when you bought into the stock. Idea is to hold them for as long as possible, provided earnings growth does come about. So, I think the philosophy and the process that we are following has stood the test of time. We have seen sharp corrections, drawdowns in the markets on the back of, abnormal situations, whether it be the global financial crisis, Asian crisis, European crisis, and all of that. We've seen portfolios and stocks getting drawn down by 20-30% also. A Page Industries from 400 rupees, 10 rupee paid up to a 45,000 crores, right, has lived through the growth journey, compounding profits between 2010 and 2017-18 at roughly around 37%, right? Having said that, the P multiples at 20 has become 100, 526 crores of profits, 50,000 crores of market cap. It is roughly at around 100x multiples, right? But the truth is that for Page Industries, even now, the earnings growth will come about at 20-25%. And there's still a lot of terminal value that's going to be left after 3 years, right? Because the market shares, if you see in the men's segment or the women's segment, is nowhere close to saturation, just about 18-20% in the men's segment. And they're expanding the market for themselves, market like athleisure. junior, or let's say kids, and ancillaries like your socks and towels and many more to come. They're expanding the market for them. So one really needs to figure out as to whether the company, when it's about to go through some sort of stagnation or saturation, or about to go through a decline, whether the company is reinventing itself to achieve that 20-25% sort of a growth, right? The rules of investing have not changed over the last 100 years. The same consumption, savings, and investment themes are going to hold good in India's journey of growth. India is a growth economy, and growth is nowhere close to saturation. We are not averse to finding companies in any of these spaces, right? Consumption, savings, and investment. There is cyclicality across all sectors and companies at all points in time. The idea is to not get into businesses which are very, very cyclical from a global point. So commodities, they give you obnoxious returns in very short time periods, where they collapse also like that. That's the structural nature of these businesses, right? Media as a sector really does not have that big a profit pool in itself, the entire sector put together. So some of these sectors will look through a lens as to how is the cycle going to play out, how many years of growth, and then after there will be degrowth. So sector rotation is all a function of where we are going to see accelerated growth within the band that we want to achieve, the earnings growth on these companies. We have enough data. Data is available real time. I think there is a difference between data and information. We have to sift out information and to again maintain the same hygiene, principles that we have always dealt with in the case of management quality, longevity of growth. We are again in disruptive times. The business model should not get disrupted. When we look at businesses from the next 5 to 10 year perspective, they should stand good in the current business model, because Michael Porter's 5 forces model is relevant at all points in time. There has to be red flags. So checks and balances are all a part of the investment process that we follow. And within that framework, we are not averse to rotating out of stocks or sectors at any given point. But this is also a truth that in the world of wealth creation, you must have the vision to see, the courage to buy, and the patience to hold. And the last one, which is the patience to hold, is the crux to creating wealth. You will have many new ideas on any given day, a new day. But as Peter Lynch has very rightly put it, that you should just stay put with the stocks, even though you have many brilliant ideas on an ongoing basis, day by day. Unless and until you find a really compulsive case of a very brilliant idea that could substitute one of the existing ideas in the portfolio, and the growth on the portfolio stands good at 18 to 24% compounded, I think it's best that we should actually stick with the stocks.
Sure. So, Samit, while Manish sticks with buy right, sit tight, and he kind of says that the maximum attribution of the potential 10x kind of return would come from longevity and that conviction. And that we saw working in last 10 years. In your context also, you took the example of Lao Pala or Bajaj Finance, or even stocks like Pidilite. Pidilite gave 30% CAGR return, Bajaj Finance more than 50%, and likewise. So over next decade, if you are unable to identify some of such potential multi-bagger stocks, 2, 3, 4 of them, as you mentioned, would you still kind of not do sector rotation and still not do kind of, more churn to be able to, get the expected returns closer to 10x, or you would do that?
Right. See, investment is all about, the future, right? So if you have a stock which you were lucky enough to pick it up at a certain point in time, right? So if you bought it at X and it becomes 3X, right? Just because, you have that cushion that you have, bought it at, and you're sitting on such profit, doesn't mean that you have the flexibility to hold on to that stock, right? I have to keep on looking at, is this a stock where the potential of earnings doubling over the next 3 to 4 years exists, right? So if I'm targeting 18% to 25% kind of a earnings growth, that means earnings have to double either in 3 years or max in 4 years, right? So every stock that I hold in the portfolio, I need to make sure that if I have to build up my portfolio right from zero today, will I hold or buy this stock? If I don't think I'll be able to buy this stock today. Looking 3-4 years, I should not hold it just because I had bought it at great price before, right? So that is an evaluation that one portfolio manager or an investor has to keep on doing at every point in time. It doesn't really matter, right? Now, if you don't see, I mean, if the fundamentals of investment, as even Manish was saying, doesn't change, right? The fundamentals for analyzing the earnings growth will be based on the competitive advantages, what are the moats of the companies and what will enable the company to grow without the competition really kicking in. Right? And the second is what will enable the valuation re-rating to happen. Right? So there are a couple of things. So earnings growth, everyone knows about, what will, everyone talks about it, the moats, competitive advantages, right? The valuation re-rating is not possible all points in time. As I said, it will be in a concentrated period, but at least you need to understand what are the factors which will enable that valuation re-rating, right? Where if you invest in a company where the market perceives that it's a very risky business, generally you will get lower valuation. But because of your maybe having a better understanding of that business, if you think, that this business is extremely strong, it may be in a weak sort of sector where everyone gets low valuation, but you enter into that company and slowly over a period of time, it proves its mettle and then showcases that it is extremely strong. It's a structural story. It has a huge moat. As soon as investors slowly recognize that, they end up giving higher and higher multiple. I mean, the kind of investor who comes into the company determines the multiple of a company. For example, if a small cap investor, invests wants to invest in a company, his expected return from that company is going to be high. It will be 20-25%. If you think that company is going to deliver 12% return, he will never touch that company, right? Because it doesn't meet his requirements. Right? Whereas if you have an FII, large investors who come into companies, they are looking for consistent compounder. They are fine with low returns, but they don't want too much volatility, right? So once the company sort of proves itself that this is going to be a consistent compounder, and even if it delivers 12, 13, 14% return, a lot of foreign investors will be interested with that 12%. And look at the difference. If you have a company with exactly the same cash flow, future cash flow, right? If you discount it at a rate of 18%, you get a multiple which is 1/5 of the multiple if you discount it by rate of 12%. That's how sensitive the discounting rate is on the ending multiple, right? So you need to get in companies where you know that going forward, more and more safety kind of investors will be interested in this company. And at this time, everyone thinks this company is going to be extremely risky. That is the edge you develop in, and there is no option or no alternative but to understanding the business better than anyone else. So understanding a business better than anyone else enables you to give it the right multiple before everyone else gives it the right multiple, as well as enables you to estimate what is going to be the growth rate. So there is no rocket science, but just doing the fundamentals right and doing it across all the companies, out of which there will be 2 or 3. I always estimate that 15-20% of my portfolio companies should deliver me those returns that I told about. Generally it happens 10x in 3, 4, 5 years. It doesn't happen in 10 years. Most of the time it will happen in 3, 4, 5 years. It plays out. And at that time, most of the time, if you look at the next 3, 4 years, things will look very different. So most of the time, it's time where that the valuation multiples are way above what I am comfortable with, and the growth has also slowed down. It happened for me in Page Industries. It happened for me in PI Industries. A lot of companies, it happens, and that's what you do. So you got to take each day as a new day, thinking I am building a new portfolio. Forget about what you hold in the portfolio. If you are having the confidence that I will buy this company even today, then hold it on. You can hold it for 10 years, 15 years, but just make sure that you test it out every day.
Sure. Manish, now the next question that comes to my mind subsequently is that given the current environment, of the macro structuring and the micro structuring and the way forward, today, if you have to build a portfolio for 10x return in 10 years, do you find any such business models which can generate returns like Bajaj Finance or Page Industries over next 5, 7, 10 years? Would you like to kind of discuss some of the ideas that you're liking, that your research is throwing, and you're kind of finding them very, very interesting in this context?
Yeah, I mean, their businesses are evolving, consumption styles are evolving. So, few of the areas which look very interesting from a sector stance point of view as we speak, and given the structural backdrop, deglobalization being the norm, globalization was the norm. You are looking at economies closing as opposed to economies opening in the last decade. You are seeing the consumption patterns of millennials changing. So one of the areas where I seem to be very excited going into the future is your retailing space. India is a huge market, huge in terms of the amount that is there, the business opportunity. 65, 70 lakh crores of retailing happens in India. We have seen many new businesses come onto the listed platform. Of course, valuations were not right. A few of these businesses are really going to become very big going into the future. The idea is to identify which ones can pass through the stressful times of the macroeconomic conditions that we are faced with. If they are able to survive, most of them will actually fall by the wayside. 80% of these new age businesses or within the e-commerce platforms, they will fall. But 20% will survive and they'll grow and thrive massively because the size of the opportunity is just too big. This is one space. In terms of deglobalization, I think defense will be another space which, you can buy many companies where the whole market seems to be simply disbelieving the size of the opportunity out here. You don't have too many private entities in this space, but still, whatever is there, within the opportunity set that is available to you, both in the unlisted and the listed space. That is why I say unlisted is also important because you buy the companies as young as possible. The big opportunity set is massive. So, these would be green energy, green hydrogen. It could very well be a possibility that $2 of hydrogen is available. A lot of work is going on, electrification, batteries. These are some of the new areas where one needs to focus on, trying to understand, how the markets are valuing them currently and what valuations we are comfortable with, like the rule of 40, applied to new age businesses. Just doesn't seem to be standing the test of time given the high cost of capital that we are in, the cycle that we are in. But at some prices, many of these stocks which have already come in the listed space, or even some of these companies which are still there in the unlisted space, will make a lot of sense. And there is where the multiple X returns is possible in a few of these names going into the future. So continuous work, continuous learning from these businesses as to how things are evolving will create opportunity sets. That's my belief.
Sure. Thank you so much, Manish, for your insights. Moving on to you, Samit. Your style of investing kind of is more objective in terms of identifying those businesses where you can clearly see the possibility of earnings growing by 2 times over next 3 to 4 years. That is your ideology. Now, in that context, how do you see some of these new age businesses, and if they do not fit into your ideology, what are the other kind of businesses which in this current environment do you see give you confidence in that context?
Right. So, to start with, I generally do not think in, 10-year kind of horizon at all, because I think it's extremely difficult to know how a business is going to evolve, especially businesses who are high growth businesses, because they are in a very emerging kind of an environment, and there are a lot of disruptions which can come in. Right? So I keep on thinking in that 3-year kind of a period, what will happen in this business in the next, because not even the promoter knows how his business is going to be in the next 10 years. So forget about me. Right. So I keep on thinking in terms of 3 years. And as I say, my expectation in that 3 years, ideally, the earnings should double. if you look at my 10 years, initially I used to have more of, sorry, initial period was more of consumer oriented companies like Bajaj Finance or Sera, Kajaria, Page Industries, those kind of companies, because I could see that I thought that the multiples were attractive. At the same time, I could see a huge growth possible, right? Problem with the new age kind of companies today is the starting multiple. The starting multiple is high, and as I said, you can never have a 10x in 10 years without really at a portfolio level if you don't start at low multiples. So that is very important, and hence I keep on taking a 3 year kind of a period. And as I said, it's a rolling ball. You keep on every day in the future. You keep on looking for next 3 years, next 3 years, next 3 years. You end up, you may end up holding it for next 10 years or 15 years or 20 years, right? But it's a derivative of just 3 years looking forward. Today, where I see the possibility of that kind of earnings growth at least, and reasonably attractive valuation, a lot of manufacturing companies. So export, we are going through deglobalization kind of a phase, and I feel India will be a beneficiary of deglobalization, because globalization mainly happened that China became the manufacturing factory for the world. I think it will now deglobalize and spread out, and India should be a beneficiary. So manufacturing, export-oriented manufacturing should be a big beneficiary. That includes a lot of engineering goods or capital goods, whether there are bearing manufacturers or really high level engineering manufacturers, specialty chemicals. I think the specialty chemical problem is the growth. Earnings growth is there, but a lot of the P multiples have been already re-rated. Right? Even auto ancillaries, I see the valuation multiples are extremely attractive, and given that we formed a low base, there is a huge potential, especially auto ancillaries. We can cater to the ICE engines or the electric vehicles, right? That I see textiles, I see real estate, because it will go through a phase, and this is what I see over the next years. There are a lot of triggers. I am okay being a little late to a theme, but I do not want to preempt a theme where my failure rate is going to be very, very high. For me, as I said, 20% of my portfolio I expect to deliver that 10x returns in the first 5 years itself. But the remaining portfolio, 80%, should at least deliver market returns. And market returns, you cannot generate market returns if there are too many failures in the portfolio. So my first job to deliver market returns is to avoid big failures in the portfolio. And I can only do that by being a little conservative, that let the theme play out, let it start, let me get that confidence. Even if I lose out on the first year of that theme developing, I'm completely fine. So you will never find me investing in a loss-making company or a theme which is just emerging, where people have too much hope in that theme and everyone is piling up into that kind of a theme. But those themes that I spoke about, that's where I see it. I am completely fine waiting out how electric vehicles will play out, how these e-commerce, new age kind of companies are playing out. Because if this is a long-term theme, it will play out for the next 10, 15, 20 years. I don't need to participate in the entire 20 years. I need to participate in a phase where the risks are low and the returns are reasonable, or which meet my kind of targeted returns. And that's what I will keep on waiting for. And I don't think it's the right time for me to get into these new age companies given the starting valuation.
Sure. So basically, to kind of build a portfolio for returns closer to 10x in 10 years, the starting point in terms of valuation should be good. The business should have quality in terms of management, in terms of its financials. Also, one should have a temperament to hold on to that business for long term, and longevity is required. Apart from these three things, what are the other recipes? What are the other ingredients for this 10x kind of return in the portfolio? Over to you, Manish. Apart from these three factors that we have discussed, what other I would say attributes or ingredients are required in a portfolio to attain a return closer to 10x in 10 years?
Yeah, so few of the things which are at the back of everybody's mind is that the economy itself should be in a tailwind. right? So if we are talking about, let's say, $2,000 per capita income for India currently, and we see some social and basic economic infrastructure that's get created in any economy, and it fits within that targeted per capita income, that economy really goes through a J curve as the per capita income trajects from 2,000 to $4,000. We have seen that in China from 2004 to 2014. We have seen that in Brazil, from whatever 3,500 to 13,500, something like that. So India is at the cusp of a golden decade. It's before it. I mean, this is my firm belief. Leave aside the near-term uncertainties that are there. This trajectory of a 3 trillion going to 6 trillion is unstoppable. Give it a few years here and there, it is going to stay. Within that, the basic pillars of the economy, which is your consumption, savings, and investment, are going to be in massive tailwind. Added to that, apart from the four major reforms that India saw, demonetization, RERA, GST, IBC, we have three overlaying themes of PLI, China Plus One, Atmanirbhar, right? These are all anecdotal to the fact that we got to look out for sectors which itself are in a tailwind. If we talk about specialty chemicals, it's a play on the China Plus One. Now we got to identify on companies which can deliver 25-30% compounded for as many years as possible. Right? If we talk about Atmanirbhar, defense is another area. If we talk about consumption, any form of consumption is today overlaid with tech, fintech, medtech, health tech, e-commerce. These are unstoppable areas, right? And so I think, first of all, to find a 10x in 10 years, the sector itself should be in a tailwind. Very rarely will we find, companies or within a sector which itself is headwind. We were in times when telecom used to attract 16 rupees a minute in terms of tariff rates. The sector was in a massive tailwind. ROEs were in excess of 25-30%. Then the sector went through a massive headwind on the back of massive auction prices of spectrum and, tariff falling to as low as 16, 17 paisa, 5-6 paisa per second. So I think sector tailwind is a part of the identifying individual stocks. Headwinded sectors rarely find it, that you can't have a brilliant company run by a brilliant sector if the sector itself, is headwinded. So, one needs to find sweet spots in the economy, whether in manufacturing or services or exports, where this sort of things are possible. And then you overlay it with your own philosophy and process, what businesses you understand, where the managements are good, what is the cyclicality element on each of these companies, how long is the terminal value, what is the multiple that is derived by the DCF, implied DCF, what is the sort of margin of safety. I think these are some of the principles which could be applied on an ongoing basis.
Sure. So we have more or less discussed, all the required ingredients. And the most important one is the conducive economy. And as Manish reiterated that we are in the golden phase, definitely, the aspiration for making 10x returns over next 10 years is very valid. And because opportunity doesn't knock your door always. And if it is a golden decade, one must make, all the, I would say, all the right attempts to achieve that kind of returns. Now, my last question, last set of two questions, one from you, Samit, is that in the beginning you had mentioned, and I have heard this from even Siddharth, who is also, in the similar category, and that is why he was supposed to be part of this panel discussion, that we are not AUM chasers. We are alpha chasers. You also mentioned that as the AUM in the fund will continue to rise, the possibility of alpha will reduce. So what is that point, from the perspective of investors? Now, from your point of view also, your AUM has grown over last 5-6 years tremendously. You have reached 3,000 crores of AUM. And I see that because the track record now is for last 10 years, the performance is very good. A lot of distributors are signing up with you, large distributors signing up with you. So over the next 10 years, obviously this problem will come to you also. From that point of view, how will you strategize this? And from investors' point of view, how should they select at what level, a fund should kind of not be given that kind of expectation that this fund will not give me 10x returns because the AUM is moved beyond this level?
Right. And I have given a lot of thought to this because, it is going to be one of the most important things. See, because see, as a business and as an investor, they are at a conflicting end, right? Because for me, getting more and more AUM doesn't add much cost structure to, my company. And, most of the top line flows down to the bottom line. It's a very, very fixed cost kind of an industry. There is not much of a variable cost, right? But the more I add, of course, it's going to take away from the returns of the investor. The thumb rule that I use, which based on my experience, has worked out for me, is that I need to manage less than 1% of the total market cap of the portfolio. So if, say, for example, I have 20 companies with average market cap of 25,000 crores, then I basically have 5 lakh crores. 1% of that is 5,000 crores. That's the limit, right? So today, I'm not at 25,000. It's probably lower than that. That is the highest limit. I should target to keep it much lower than that, maybe 0.8 or 0.9% of that. And that's what I target to do. In 3,000 crores, 750 crores is in the small cap and the remainder is in the mid cap portfolio. But each of them today is at 0.6%, 0.5, 0.6%. So I have some room, but as soon as it reaches maybe that 0.75 or 0.8, that's the point I need to stop. Either I need to stop or I need to move up in terms of higher market cap. So if I move from, say, 25,000 crores average market cap to 50,000 crores, I cannot generate the same returns by investing in those, sort of more closer to the top 100 companies. So that's the thumb rule I use. And as an investor, I think one has to look at that, because that's the last thing investors think. Investors keep on thinking about, a lot of other things, but this is one of the more important aspects for a fund manager to enable him to generate those high returns.
Moving on to you, Manish, do you buy this point that the higher is the AUM, the relative alpha will get reduced and it becomes, difficult to kind of generate consistent alpha with the growth in the AUM?
Look, in a long-only style of investing, secular returns year by year is quite difficult. We were also in times where absolute returns were in excess of 22-23%. Alpha was in the region of 10%. Right, from 100 crores of AUM, we moved to a high of 11,000 crores of AUM. So, and PMS as a product is an extremely difficult product. Not from the point of view of ideation, but from the point of view of operations and getting the transactions done. The price impact is just too overwhelming from the point of view of the fact that, the clients do come to know the trades at the end of the day, because these are portfolios, individual portfolios. Now, some of this has got mitigated through the AIF, right? PMS as a product is very difficult to scale up beyond a certain size. You have outliers in the industry, I don't deny that. But as a general principle, if the scalability point of view has to be taken into account, it is the AIF route, not the PMS route. Within the PMS route, as the size of the AUM becomes higher, and you're not able to get the transactions get done at your required price impact, it impinges on your returns, and therefore alphas, if it is 5% on a large AUM like that of ours, it's a massively good alpha that achievable. 10% very difficult, 5% is extremely doable. But, and that is why the proliferation of the AIF structure, because there you actually operate on a NAV concept as opposed to customized individual portfolio concept. And as the size of the AUM becomes bigger, obviously one needs to keep into mind the liquidity aspect. See, this is one aspect which is overlooked in portfolios, particularly so when we talk about the mid and the small cap space, particularly the small cap space. Clients must analyze the liquidity profile of the portfolio. Reported NAV and realizable NAV on an individual portfolio will be totally different. This is because in times of up move in the market, liquidity gets augmented. In times of down markets, liquidity gets squeezed. So what may be reported as a particular price, exit price on a daily basis, when the realizable value of the entire quantity of shares in a particular stock needs to be offloaded, the price impact is simply too high. So reported NAV and realizable NAV are the two important parameters that should be monitored on an ongoing basis when it comes to computation of return. That is why large AUMs will have no choice but to meander the corpus 50% or 60%, 65% towards your large cap, just to maintain the risk profile on the. I mean, the first and foremost job of a fund manager is to contain risk, right? Any form of risk, concentration risk, liquidity risk, manager risk, management risk, so on and so forth. So containing from a risk containment point of view, it is imperative that large AUMs will have to move towards large cap, around 50% or more, and look at the dichotomy. If you are running a multi-cap portfolio, the index generally is the NSE 500, right? Now, if you look at the composition of the NSE 500, is 76% large caps, right? 76% large caps. So if you deviate significantly away from the benchmark which you are having, which is more aligned towards the large caps, of course, the idea is to find the brilliant companies within the large cap space, because everybody wants to get rich very quickly, and particularly so in the PMS space, because otherwise it makes sense if it is 100% large cap, you buy completely the passive funds, so on and so forth. So some element of the mid cap and small cap needs to be there. Your benchmark needs to be kept into mind, and thereafter the composition of the portfolio needs to be created.
Sure. So moving on to the last question, Samit, you have in the last 2 minutes. So, in your all the portfolios like Sage 1 core portfolio and Sage 1 small cap portfolio, what I have noticed that the allocation to IT and financial services is relatively very low in comparison to any other portfolio. And obviously, we are expecting a return which is like a multi-bagger return. So is there some kind of a relatively less positive view on these two sectors, which are actually two heavyweight sectors, with regards to any other fund, any other product?
Right. No, there is no negative view on any of these sectors. It's just that IT is something where the historical growth rate has been lower than what we look for. It doesn't deliver that 2x in 3 or 4 years. Same thing is with the financials. I mean, there have been financials like Bajaj Finance and which have delivered, and we have taken a bet on those, right? But I think today what I see is the deleveraging has been so strong over the last year and a half that companies are fine doing capex with just their internal accruals, right? So I think the same formula like what we saw maybe in the first decade, right, where there was huge capex boom, which was going into telecom, which was going into real estate, huge infrastructure, build up, power plants, there were cement plants which were built up. That kind of boom, I don't see it, happening over the next 10 years, right? Like, which are the sectors which can see that, right? And even then, there were so many excesses in funding, right? There were a lot of sort of over invoicing, over projection of the, project cost, all of that, I think, which is extremely difficult with IBC and all of that in place, right? So I think the growth in the finance sector will be closer to probably the nominal GDP, which itself is a struggle. You can see that because the companies are, good companies are able to do it with internal accruals. There are a lot of, new age companies which get funding from outside, right? And there are a lot of renewable energy projects which also get funding from offshore. So why would there be so much need of credit, right? Of course, I mean, you will make returns if you get in and get out at the right time, because now, financials are getting cheaper. So whoever can time it right, and, and even if with 12, 13% kind of a growth can deliver, with some re-rating in the valuation, it will also, generate, but that's not our style. So we do not find anything which meets our requirement. Say IT is something which, maybe we were a little late in starting when the, the post-COVID, because we were able to find other companies which are growing at much faster rate, right? So, and today the IT multiples, from the historical averages, went as high as 3x. All the IT multiples went up 2x and 3x, and that's where IT returns were so high. Right? Going forward, the growth rate is going to be in low teens, which is very difficult. Maybe there will be one-off companies, few companies which will deliver you that 18-25% kind of a growth. But then you look at the valuation of those, they are more than reasonable, I think, and that's where we are not able to find. So it's all about relative opportunities, nothing to do with specific negative at an absolute level view on those sectors.
Thank you, both of you. It has been really pleasure conversing with you. And I think, both of you have wealth of knowledge, and that has kind of made this session very, very intuitive. And I would say to all our audience who have been kind of watching us that, though we all of us understand that equity as an asset class is an asset class which has always outperformed in long term, and especially over next 10 years, because most of the fund managers who have been coming out of the firm belief that we're living in the golden decade. And hence, to all the investors, I would urge that kind of keep that conviction going. And if you seek any advice, if you seek any consultation, we have a very, very fine and a deep framework, which Aishwarya also mentioned, by name Quality, Risk and Consistency Framework. And you are more than welcome to kind of knock the door of PMS AIF World, and we'll give you a very, very fine service.